All right, what's happening? What's happening? We're going to be covering divergences in this video. So when an indicator and when price is at a argument of where it's going to continue, we have divergences to know whether the trend will continue or reverse. So the slideshow is actually going to cover all of it. We don't even have to hit the chart. So I'm going to share my screen. Cashews, walnuts, macadamia nuts. I'm hungry. I haven't hit the gym yet. So I'm starting off with some, with a healthier option before I go to the gym. Not only is trading wealth, but so is health, right? Gotta make sure we're always working on our health. It's okay to have some treats and some snacks and indulge in some not so healthy things. But one of the biggest things in life is the smaller disciplines, which lead to the bigger ones. So, all right. Let's see what we got here. Boom. Here we go. Divergence. So, divergence is used to identify potential trend reversals or shifts in the market momentum. So it occurs when the price of an asset and a technical indicator move in opposite directions, suggesting that the current trend may be weakening and a reversal or correction could be generating. Divergence can also be observed on various types of technical indicators, including oscillators and momentum indicators. The first type of divergence is regular and hidden divergence. Regular Regular divergence occurs when the price of an asset forms higher highs or lower lows, while the corresponding indicator fails to do the same. There are two types of regular divergence. The regular divergence is bearish and bullish, right? So bearish regular divergence is when price is making higher highs, but the oscillator is making lower lows. Notice with the arrow, right? We have higher high and we have lower high on the alligator oscillator. So this occurs when price makes higher highs, but the indicator makes lower lows. This suggests that the upward momentum is waning and potential reversal to the downside may occur. So notice how when that divergence formed, the selling momentum increased, but the buying decreased, and it did shift into selling momentum. Interesting, right? Bullish regular divergence. Bullish regular divergence is when price is making lower lows, but the oscillator is making higher lows. So notice here that we're in that selling region, right? We're looking at selling momentum. That the price, the data that's printing on the chart is selling, but we notice that we have a lower low get created here, but the oscillator is starting to make higher lows here. Look where price shifts, right? Price then shifts into buying, and the oscillator then shifts into buying as well. But notice that difference, right? After this massive move on the oscillator, we notice that the oscillator starts to make these higher lows. So momentum is weakening and a potential reversal to the upside might occur. So those are that is regular divergence. Regular divergence is when you use the oscillator and the price and look at the type of momentum and movement between the two. Hidden divergences. Now we're going to talk about the second one, which is hidden divergences, right? We had regular, now we have hidden. Hidden divergence, also known as continuation divergence, occurs when the price of an asset forms lower highs or higher lows, while the corresponding indicator fails to do the same. Hidden divergence suggests that the current trend is likely to continue, then reverse. So let's look at the two types of hidden divergence. The first one, bearish hidden divergence. This occurs when the price makes lower highs, but the indicator makes higher highs. Price makes lower highs, but the oscillator is making higher highs. When the price makes lower highs here, right? This one's lower. This one here is lower than this one, but the indicator makes higher highs. This is higher than this. It suggests that despite the price showing a temporary upward move, which is here, the overall trend is still bearish. Divergence is a little trickier to spot. I myself have trouble finding hidden divergence. Within the trend, when you start to see that buying and then it makes that lower high, the oscillator making that higher high, it's sometimes tricky to spot that and exactly where it is, right? But here is a great and the best example of bearish hidden divergence. Now, bullish hidden divergence occurs when price makes higher lows, but the indicator makes lower lows. So let's look, right? Price is making higher lows. So these set of lows is higher than this set of low. The oscillator is making lower lows. So notice here that this is lower. This right here, this momentum is showing that this is lower than this one here. Price is making higher lows. Oscillator is making lower lows. Price is still in an uptrend. That one's tricky. Look how close it is too. That's a tricky one right there. So we have two types of divergences, regular and hidden, and then we have bearish and bullish in both categories of regular and hidden divergence. Much quicker of a lesson today than most. I know that the intermediate videos are a little longer. They do have more to cover in them than the beginner. This one was a shorter one. However, divergences are very helpful to look for when it's just in a massive uptrend and you're like, when is it going to correct, right? When is the market going to finally retrace? And you can use divergences to find that potential reversal within the market. So if you want to reach out to me and schedule a call to go further in depth on divergences, let's make it happen. You know where to go on the website. I hope you enjoyed this video, and I will see you in the next one. Peace.